Ladies and gentlemen, if you were to put together a list, a morphology of steps that would lead to the next eurodollar crisis, the next collateral shortage, you would find on that list something that China just did. So are we indeed heading towards another dollar disorder, another monetary shortage? We're going to talk about it in a moment. But first, friends, did you know that you can interact with the show? Yep. Simply go to YouTube and enter questions into the comments section. You can ask questions about the eurodollar system or personal questions. For example, sometimes I'm asked by people, wow, Emil, it seems like you have it all. You've got a YouTube show, books, you've got a suit. How do you do it? And typically I respond, wow, that would be like walking up to Pavarotti and saying, teach me to sing to you. And I scoff at them. But, ladies and gentlemen, you can follow in my footsteps in at least one area, and that's by attending the Practical History of Financial Markets with Russell Napier, which is going to be hosted in London from October 7th to October 9th. A Practical History of Financial Markets course. Yes. Do you want to know how to identify the bottom of a stock market, bear market? Let's see, Russell Napier, he wrote a book about it. What about financial repression? What does it mean? How is government going to go after savers? These are all questions that can be brought up to Russell and his collection of market participants as they teach you things that are not in the textbooks. So just go to the Google, A Practical History of Financial Markets course, type in Russell Napier, and then you'll find the details of how you can attend this course. Jeff Snider, head of global research, is on the edge of the shadows, and we're going to go to him live. Jeff, welcome to the show.
Thanks, Emil.
All right. Jeff doesn't know what to say right now because I'm trying these new introductions and he doesn't know what to think of them. I don't know what to think of them, but this is your opportunity to go to the YouTube comments section and say, keep practicing. Jeff, you ask, how do you spell escalating? China, July 9th.
Yeah, CHINARRR.
July 9th
that's how you
at
spell
Alhambra
escalation.
Partners.
Yeah.
That's right. And you say there are 3 letters you never want to hit the Chinese news. I thought maybe USA, CCP, WTF, and then in the previous episode I said RRP. Jeff, what are the 3 letters?
Yeah, what are the 3 letters? Yes, the 3 letters are the same letter repeated 3 times, which is RRR. Which, I mean, depending on how you arrange the letters, those stand for required reserve ratio, which is essentially Chinese bank regulators, the PBOC, telling banks how much in reserves they have to keep in reserves, therefore they're not allowed to use. How much bank reserves cash do they need to keep on their books in order to be in compliance and stay in the good graces of monetary authorities. So it's a rate.
If I opened up the New York Times to the business section, what would the New York Times, as the vanguard of the mainstream establishment media, say the China RRR means when it's lowered?
It means terrificness. It means stimulus. It means awesome. This is great. The PBOC is cutting rates and allowing banks to flood the Chinese economy with, I think you see estimates of a trillion RMB, because that's how much reserves will be, quote unquote, unlocked by a lower reserve requirement ratio.
Okay, well, you've caught me. Where do we go next then, Jeff? I've got a section here highlighted, and maybe I'll read that out because it says read. At one time, all the way back in 2011, the RRR for large banks was an unbelievable 21.5%. Over the decade in between, according to accepted conventional theory, by reducing the RRR, this must have flooded China with trillions upon trillions of RMB. Banks were allowed to incrementally use to stimulate the Chinese economy. Only the Chinese economy has gone in the opposite direction during those 10 years. The money must instead of be missing, as is the economy. So much for the theory.
Yeah, so let's step back here. Let's review our history of China RRR. We'll bring in the Chinese yuan exchange rate. We'll look at internal money, external, and eurodollars, because that's what we're really talking about here. China's RRR, as we say, is a warning, but it's a particularly useful warning because it contains all of the elements in the global monetary system and global economy sort of compacted down into what looks like to be a Chinese technicality or a Chinese quirk. You know, this is something that the Chinese do, and how does that relate to the rest of the global economy? Why are we thinking that it's a warning? And when you look at, you know, what RRR is in the history of China over the last couple decades, the 21st century in particular, what you see is there's a very tight relationship between all of these things, starting with the eurodollar system. As dollars are created in the offshore bank-centered system, quite a lot of them ended up in China, because why wouldn't they? China was a growing emerging market miracle where a lot of people wanted to go to. So a lot of dollars end up in China, and the way the Chinese manage their quote unquote hot money system, or, you know, through via exchange controls, a good chunk of those dollars as they come into China end up in the hands of the People's Bank of China. In fact, the People's Bank of China, on its balance sheet, on its asset side, these foreign assets form the basis of the Chinese monetary system. In other words, RMB is essentially dollarized, and it has been for decades. And where this got into you know, extreme proportions was in the 21st century, as the eurodollar system really hit its final manic stride, and a lot of dollars flowed into the Chinese system. A lot of them end up in the hands of the PBOC, which requires the PBOC, because if the asset side grows, the liability side has to grow equally. Therefore, they have to create money as internal RMB money as the offset of all of these dollar inflows. So dollars go in, end up PBOC. PBOC creates RMB, mostly in the form of bank reserves, but a lot of currency too, in response to the dollar inflows, all hoping to maintain some semblance of balance in the currency exchange rate, while attempting to not let the domestic inflationary problem become too severe. And the way that they do that is because they're forced to create all these bank reserves as dollars are flowing in. They tell the banking system, we're going to lock up your bank reserves. Yes, we're going to create these bank reserves as we take these dollars out of your hands and give you RMB in place of them, but you're not allowed to use them. So you have a lot more RMB bank reserves, but we're not letting you use all of them. You're going to have to lock up a portion. That's the RRR. So all of these things happen almost in a chain of causation. Dollars go in, PBOC takes them on, RMB bank reserves go up, and the RRR goes up in order for the PBOC to try to control inflation. So you have an external, internal direct relationship between dollars, RMB, People's Bank of China, and in the exchange rate of CNY versus the US dollar.
And right now I've pulled up a graph from your article that shows the relationship between the RRR and the US dollar and renminbi exchange rate. And from 2000 through 2008, what do we see? We see the exchange rate strengthening in favor of the renminbi. The US dollar is losing value relative to the Chinese currency, and the RRR is rising because for reasons that you just explained. But then we see steps down, Jeff, and they aren't random. They're not, oh, well, why don't we just do it here, there? No, they coincide with external dollar shortages. July 2008, July 2011, January 2014. It goes on and until even recent day, January 2018. We see the RRR is lowered every time there's a problem, a global monetary shortage.
Yeah, because this process I just described up until, you know, really 2011 actually works in reverse. So if dollars are going in, that creates the, you know, the PBOC's balance sheet increases, more money in China, more higher RRR to reduce the inflationary potential. In reverse, it works almost exactly the same way in all of the inverse ways. Dollars suddenly don't show up in China or actually recede. Guess what happens? There's fewer dollars for the PBOC to put it on its balance sheet. Therefore, the bank reserves, currency, money side of the PBOC's balance sheet can't grow, or in some cases, especially after 2014, starts to shrink. And so the PBOC now has to deal with a dollar outflow situation, which is highly deflationary. And during these periods where there are fewer bank reserves because the central bank's balance sheet is actually shrinking, they have to then try to let the banking system make up for that monetary shortfall by reducing the RRR, so that in the exact opposite situation as before, they say the banks, now you're going to have fewer bank reserves, but lower RRR, which means you'll be able to use a higher proportion of fewer bank reserves. And the idea is that with the lower RRR, they can potentially manage not their inflationary potential, but the deflationary potential of this entire system going in the wrong direction or in reverse. So dollars out, PBOC balance sheet stops growing or shrinks, fewer bank reserves, and an even lower currency growth, and the attempted deflationary offset, which is a lower RRR. Now that sounds like it's a good thing. It sounds like stimulus, but as you just showed on the chart there, what we see is that whenever the PBOC is cutting the RRR because of this dollar problem at the beginning of the causation chain, it's a warning sign because it doesn't work. It doesn't actually lead to stimulus, because in a dollar shortage, global economy, deflationary, going the wrong way situation, Chinese banks are going to be risk averse, as well as a number of bad things going on too, which means, yes, the RRR goes down, and theoretically they could pump more RMB into the real economy, but in reality, they're not going to be willing to do any of those things. And that's what actually happens.
I had 2 paragraphs highlighted here that I wanted to read as being very important, and that's all I had. So let me know, Jeff, if you have any concluding thoughts. You just said one of them, which was that this is a causation chain that applies beyond China. Here you say, thus whenever RRR is reduced, rather than view it as stimulus, you need to see it as a warning. And we were just talking about this in our previous episode, a morphology. The triple R might be one of the check marks. Another one is a collateral shock day. Then a landmine when U.S. Treasury yields or other sovereign bond yields accelerate lower. So it's building, it's gathering. Here's my last contribution to this episode, Jeff. These eurodollar squeezes or global dollar shortages are never one-off or short-run situations. They are long and involved processes that play out over a prolonged period of time. Each time, their earliest days or initial phase is marked and described by a series of escalating warnings, curve distortions, rising dollar, falling yields. In all 4 thus far, global dollar shortages, going back to 2008, triple R cuts in China have been just that, part of the chain of warnings indicating the monetary and economic situation going further and further the wrong way. Jeff, you mentioned a few other check marks on your list that you carry around with you at all times. Anything else on that list that we should be thinking, trouble?
Well, yeah, I just want, before we get to that, I want to back up a little bit and the RR warning signs and where they played into history. Go back to 2018, for example. We talked about May 29th as sort of the big, okay, things are really getting serious. But before May 29th, early in 2018, when supposedly inflation was, global economy going the right way, everything going good, globally synchronized growth, the Chinese cut the RRR. And this was during a time when the dollar had stopped falling and then began to start rise again. So dollar strength, that's a bad sign. And again, the Chinese RRR links together all of these different facets because it is a response to dollar shortage, or central bank perceives that the dollar shortage is going to hit their balance sheet at some point, an attempt to reconcile deflationary pressures with what they can do internally in RMB. So it's a dollar problem that hits Chinese, and therefore is, again, a comprehensive view of this entire situation. And what we're really talking about here, and especially in the context of 2021, is mainstream narrative or mainstream expectations for inflation. Inflation is coming. It's all going to be huge. And while that narrative is, solidly in place across the entire financial media, uniform, ubiquitous, it's monolithic, inflation is definitely happening. The economy's overheating. Think back to early 2018, for example. And we see all of these little warning signs kind of, they should be nibbling away at that narrative, but they never do. What they're really saying is that, no, the chances of an inflationary breakout are becoming smaller and smaller and smaller. until we get to that big collateral point where it says, no, there's deflationary stuff going on here. And that's really what these warnings are. That's what the RRR is. It's a warning that, yes, everybody in the world is convinced of inflation because they don't understand how money works. And money, by the way, and inflation are absolutely linked together. And that's why time and time again, every time we get into these situations where we hear about these inflation, the inflation narrative, think about 2014, same exact pattern. Everybody's convinced inflation's coming while we have underneath all the time, if you know where to look, all these warning signs. And eventually, yes, in February 2015, RRR cuts, which are saying deflation, deflation, deflation. And the deflation warnings, despite the mainstream noise about inflation, these deflationary warnings get louder and louder and louder and louder. And you can see them in falling bond yields. You can see them in eurodollar futures curves, twisting, quirking, as we talked about last week, all of these other things. They're warning signs to tell you. They're telling you evidence. Forget the mainstream noise. It's all this stuff about inflation. Forget it. We're seeing this build up in escalation of deflationary pressures. And yes, we are seeing that happen this year in 2021. It is happening right now as we speak. We're seeing, yes, CPIs are through the roof. The PPI yesterday, Commodity Price Index that was released, it was the highest since 1974. I mean, it sounds like the great inflation. But yet while that's happening, deflation, the whispers of deflation are getting louder and louder and louder. And then last Friday, the PBOC cuts the RRR, which to a trained monetary ear, as we just said, this covers all the facets of Eurodollar global economy. That's kind of big one. So what we're seeing is, yes, inflation, everybody's talking about, it's absolutely going to happen, but it's absolutely going to happen every couple of years. And every time it's absolutely going to happen, it's because you're ignoring all of these deflationary warning signs that are happening. And again, as you pointed out, Emil, there's a pattern to it. And we're seeing that pattern reemerge in 2021, getting a little bit louder and louder and louder.
A minute ago or so, you said that money and inflation are inextricably linked. And I just had a little warning bell go off in my mind because many people look to M2 as a measure of money. And I've heard on many different shows people say, well, they're not linked because look at M2. But as we've talked about in many shows already, M2 was disused or unusable or imprecise. It wasn't capturing what money had truly become in the 1960s. 1960s, ladies and gentlemen. So I don't think there is actually a measure of money that would capture the global monetary condition today. That's part of the problem. Perhaps that's the underlying problem of our entire show, Jeff.
Hey, as I say often, how do you put collateral into one of the M's? You don't, right? It's completely impossible.
You have to, though. You've got to figure it out.
Conceptually. But you can't come up with a number that says, okay, here's money, and have it exclude the collateral side of things. So you just conceptually, when you conceive of the monetary system and monetary condition, you have to keep in mind collateral, which is why, as we talked about before, many times before, that's what we always talk about, is why we're trying to get at all these hidden shadow spaces by seeing how that stuff that's going on in collateral and shadow spaces is affecting everything. And the way that those shadow spaces are affecting everything in 2021 is increasingly warning about deflationary pressures that are building. And as Jay Powell and I completely agree about, we're buddies now, that is even reflected in something like the reverse repo usage, which is indicative of a T-bill problem or collateral problem.
If I had over 1,000 PhDs on my staff, I am very confident, Jeff, that I would come up with a method of factoring in collateral and money, and it would be the best method put forward in the last 50 years. I'm confident I would do that. But if you're curious, maybe you just don't get around to it. Jeff, one country that doesn't have 1,500 or so PhDs on their staff of their central bank is El Salvador. And as we've recently heard, they have made the Bitcoin, the cryptocurrency Bitcoin, a legal tender, or at least it's working its way towards that. And you wrote an article, and we're going to talk about not only what that means at the superficial level, but kind of why, what led to El Salvador making this decision. And we're going to bring in something from the 15th century called ghost money as part of the answer.